Hello, everyone. Before we jump right into things, I just want to quickly mention that the information we're about to cover was prepared by Dr. Samir El-Rishani with some AI support. All right, let's get right into it. If you use a vehicle for your business here in Canada, you already know you can deduct expenses. But, and this is a big but, how much you can actually deduct depends entirely on how the Canada Revenue Agency, the CRA, classifies your vehicle. And trust me, it's not always as straightforward as you'd think. Getting this right can literally save you thousands of dollars. So, let's start with a question that gets right to the heart of the matter. Is that heavy-duty pickup truck you use every single day for your business actually considered a passenger vehicle by the taxman? The answer, well, it might just surprise you, and it has some pretty major implications for your wallet. To figure all this out, we really need to understand the big picture. You see, the CRA doesn't just see cars and trucks. Nope. They have 4 very specific categories, and every single vehicle has to fit into one of them for tax purposes. Understanding these is absolutely the first step to making sure you're getting all the deductions you're entitled to.
And here they are, the 4 big ones: motor, vehicle, passenger vehicle, and then we've got 2 for all the electric and hybrid owners: the zero-emission vehicle, or ZEV, and the zero-emission passenger vehicle, or ZEPV. Each one of these has its own unique set of rules. And don't worry, we're going to break down exactly what each one means.
So let's kick things off with the most common one, the classification that applies to the vast majority of vehicles out there on the road, the passenger vehicle. This is kind of the default category, and it comes with some really important financial limits you need to know about.
The official definition is pretty simple, really. If your vehicle is mainly built to carry people and it seats a driver plus no more than 8 passengers, chances are it's a passenger vehicle. This covers almost all cars, station wagons, minivans, and yep, even a lot of SUVs and some pickup trucks.
Okay, now here is why this matters so much. If your vehicle gets slapped with the passenger vehicle label, the CRA puts a cap on the deductions you can claim. We're talking about limits on the capital cost allowance, that's basically the depreciation you can claim each year, and limits on how much interest from your car loan or how much of your lease payments you can write off. These limits can seriously shrink your deductions. But, and this is a big but, there are some very clear exceptions. The CRA specifically says that certain professional vehicles are not passenger vehicles. So if you're using your vehicle more than half the time as a taxi, or if it's an ambulance, a marked police or fire vehicle, a hearse, a bus, or maybe it's part of your inventory because you sell or lease cars, then those deduction limits, they don't apply to you.
And this leads us to the category you really want to be in, if possible, the motor vehicle. Qualifying for this classification is like finding the golden ticket. It's the key to unlocking full, uncapped deductions for your business vehicle. So let's take a look at how you get there.
Now, the base definition is super broad. It's basically any vehicle meant for the road that isn't a trolley or a train. But here's the thing. The real test isn't the definition itself. It's all about how the vehicle is used. This is where seating capacity and your percentage of business use become absolutely critical.
And this chart just lays it out perfectly. Have a look. A regular Cooper sedan, it's always going to be a passenger vehicle. Doesn't matter if you use it 100% for business. But now, check out a van or a minivan. If it only seats 1 to 3 people, maybe you took the back seats out, and you use it more than 50% for hauling goods, boom, it's a motor vehicle. But if that same van has seats for 4 to 9 people, you have to prove it was used 90% or more for business to get it classified as a motor vehicle. That is a massive difference.
Now, for you folks with pickup trucks, there's a really interesting little exception. If you use your pickup more than half the time for your business at what the CRA calls a remote work site, and they define that as being at least 30 kilometers away from a town of 40,000 people or more, it can qualify as a motor vehicle. This is a huge deal for anyone in construction, the trades, or working in resource industries.
Okay, let's switch gears for a second. With so many electric and hybrid vehicles hitting the roads, the CRA has, of course, introduced 2 more categories to encourage people to go green. But again, you have to pay attention to the details.
The most important thing to get here is the difference between a ZEV and a ZEV. A zero-emission passenger vehicle, the ZEV, is basically an electric or hybrid version of a regular passenger car. And guess what? It's subject to the exact same deduction limits. A zero-emission vehicle, the ZEV on the other hand, well, that's a different story. It gets put into different classes that can give you much better accelerated write-offs. So how do you get your car into that better ZEV category? Well, there are 3 main boxes you have to tick.
First, the car has to be either a plug-in hybrid with a decent-sized battery, at least 7 kilowatt-hours, or fully electric, or even hydrogen-powered. Second, there's a specific time window for when you had to have bought it. And third, and this is a big one, it has to be brand new to you. That means nobody else has ever claimed depreciation on it before.
Okay, we have gone through all 4 categories. But knowing the rules is really only half the battle. Because if the CRA ever comes knocking for an audit, all these classifications are completely meaningless if you can't prove your business use percentage. And that, my friends, comes down to one simple thing: your records.
This quote from the CRA's own website says it all. Your expense claims have to be reasonable, and you've got to have the receipts to back them up. But for vehicles, there's another crucial layer of proof required that goes beyond just your gas and repair bills. We're talking about your logbook.
Your logbook is your #1 piece of evidence. For every single trip you take for business, you need to write down 4 things: the date, where you went, the specific business purpose, and by the way, client meeting is okay, but meeting with Jane from XYZ Corp to finalize the project proposal is way better, and of course, how many kilometers you drove.
And this is the step that so many people forget, so please listen up. To properly calculate your total business use percentage for the year, you need 2 anchor points. You must record the odometer reading on the very first day of your fiscal year, and you must record it again on the very last day. Without those 2 numbers, your logbook is technically incomplete and your whole claim could be in jeopardy.
So after going through all of this, what's the big takeaway? It's that getting the CRA to see your work vehicle as a motor vehicle instead of a passenger vehicle depends almost entirely on proving those high business use percentages. And the only way you can do that is with a detailed, consistent, bulletproof logbook. It all leads to one final question for you. Now that you know the rules, is your current logbook good enough to stand up to an audit? Thinking about that just might be the most valuable thing you do all tax season.